Didi, the Chinese ride-hailing app that raised over $4 billion in an IPO in New York last week, lost a quarter of its market value on Tuesday in the first trading session after Chinese regulators announced an investigation into the company. Just before the market opened in New York, the Chinese government announced it would tighten restrictions on overseas listings, endangering the lucrative pipeline of Chinese companies looking to raise capital on Wall Street. Bruce Pang, head of research at the investment bank China Renaissance, said, "This is direction from the highest level. The landscape of not only China's market, but also its regulatory framework, could see dramatic changes." 34 Chinese companies raised a record $12.4 billion in New York during the first half of 2021, according to data from Dealogic, which also showed that Wall Street investment banks enjoyed a record windfall of nearly $460 million in fees during the period. Didi led the drop in Chinese shares in New York, touching a low of $11.58 in early trading after closing on Friday at $15.53. On its opening day, Didi's shares briefly touched $18.01 before falling back. Cyberspace Administration of China (CAC) called for Didi to remove its app from the Chinese market because it had violated laws around the collection and use of personal data. It also declared an investigation into Full Truck Alliance, another Chinese company to recently list in the US, which saw its shares drop 19%. Baidu and JD.com both fell 3%, while Alibaba's stock was down 2%. Didi said it will strive to rectify any problems, improve its risk prevention awareness and technological capabilities, protect users' privacy and data security, and continue to provide secure and convenient services to its users. The group added it expects that the app takedown may have an adverse impact on its revenue in China.